If you borrow $1 million from the bank today at 6.5% interest over a 30-year loan term, it's going to cost you $2.273 million by the time you pay that loan off to zero, which means you're giving the bank almost $1.3 million in interest to buy your $1 million property. Now, if you know that to borrow $1 million, it's actually going to cost you more than double that, would you still borrow that $1 million and go buy that property if you didn't believe that the $1 million property that you buy today is going to be worth more than $2.273 million in 30 years' time? Well, any sane person would say, no, I wouldn't borrow that money because it would be cheaper to rent that property for the next 30 years than it would be to give the bank almost $1.3 million in interest. So now we know we actually need to make $1.273 million over 30 years for us to simply just break even. And that's not including council rates and all the other stuff that you have to pay. So if we work out, well, if we bought a property for $1 million today, held it for our 30 years, paid the loan back, give the bank $1.3 million in interest, how much does a property need to grow by yearly for us to simply just make back our money? And you'll see that if that property goes by 3% compounding over that 30-year period, the property's value is worth $2.47 million. Now, what I find really interesting is most people, when they look at things online and I put these videos up, they go, well, what happens if property prices fall in value? Or what happens if property prices don't grow? But most people make the bet that they buy a home and that home is going to be worth more than the interest they pay back. So at a minimum, property prices have to grow by 3% or you lose money. So everyone makes this bet by buying their own home that property prices are going to be worth more. And if they didn't think that, then why would you ever buy it? Because it doesn't make any financial sense. So when we invest in real estate, we're essentially making this same bet. We're saying, well, if we're going to give the bank this amount of interest over 30 years, we're making a bet that the property is going to grow by more than that. And this number here looks very, very similar to what inflation is. It's going to grow by more than inflation. Otherwise, we simply wouldn't do it. And the way that we make that bet is we use historical data to say, well, it's grown by 7% yearly over the last 30, 40, 50, 60 years, however long we've been tracking data. And if a property grows at 7% per annum, we're essentially making 4% gross on top of the money that we've given back to the bank.